it's hard to say today because a lot of Europe was off
good
for
point.
Easter Monday.
Good point.
So that's, we think, kind of where some of the volume coming off is coming from. We're not sure. We'll find out later. But yes, the idea seems to be that if the U.S. is not going to be the place where you can store value and count on it staying at least stable, then where do you go? And there are any number of places where you can go to find return. I mean, emerging markets are doing actually quite well right now. Right. So there are places that you can go for return, but do you trust if the global economy is going to go down as hard as some of the predictions are, then there's really no place to hide. And that's the thing. And then you hear lines from China where they're saying, bring it on. And that scares everybody because you're talking about something that's much more prolonged. And I think what Wall Street, this is all speculation about, what Wall Street in general wants, but certainty would be it. Give us what you want with the tariffs. Tell us what you want with these other countries. Let's get the negotiations going. You want to fire Powell? Fire him, for God's sake, and let us trade through it. But the
seriously, they're like,
well, that one is,
because I am curious what you're hearing. Like, this is where Tim and I love to go to, like, the Markets Live blog and see what you got, like everything that's coming in. Is the mood like, all right, just take care of these things so we kind of know what we're dealing with?
Well,
or is it a case of if that happens, then we've got some really serious trouble?
That's the flip side of this. So Powell's the one where it's like, it's a little bit different. But there is this element of, I know how to trade through this. Like, I know what to do. Mm-hmm. It's the uncertainty and the constant badgering. So if you know that, like, let's say they're going to fire Powell, and that's going to take, 6 months to sort out and whatever else, you just kind of want to get that going. You don't want to have to, sit through day after day after day of this.
Maybe, but at the same time, there are folks who've shared with us there would be big concern about the independence of a central bank if the president got directly involved here. And that is a much bigger issue for the structural integrity of how we see the economy.
That's absolutely right. And that's why nobody would take that for granted. And the idea, look, there are examples going back to Nixon of them yelling at the Fed chair. So right. It's not new for presidents to sort of badger the Fed chair, even in private. But this public constant hammering and the language that they use, calling him an idiot or whatever it was, it's just, it doesn't give people confidence. Now, when you're talking about the Fed, you're talking about the ultimate confidence machine. Like, that is something that we all have to believe in. You have to believe that it's making decisions based
It's the central bank that everybody wants to have around the world.
It's everybody's central bank.
Right?
It's exactly
right.
it. So in effect, it's a central bank for the world, and you need to know that it's actually acting that way.
That's why I wonder, like, if indeed they're like, okay, let's just get it done, get it rid of it. But then you're talking about, like Tim said, a structural fundamental change potentially in the United States.
No, I don't think anybody wants to see Powell gone. That's
I know one person who does.
I would correct that.
It seems like one person does.
Yeah, okay, not everybody, but
lives in a big White House.
Everybody X that, and I think that they've warned him about that.
Let's bring Kathy Jones into the conversation because she's another great voice on all of this. Eric's going to stay with us. Kathy Jones is Chief Fixed Income Strategist at Schwab Center for Financial Research. She's out there in Miami. Kathy, I assume you've been listening. Once again, we have an environment where stocks are down, long-dated treasuries aren't trading maybe how we think they should in a risky, volatile market environment, and we're concerned about maybe what could happen in terms of the U.S. Central Bank and the independence of the Fed. What are the conversations you guys are having with your team?
Yeah, we're trying to figure out, well, first of all, it's very difficult to know what's going to happen tomorrow or actually 10 minutes from now. So it is difficult to map out a strategy because, you want to start with an investment thesis, move to a strategy, and have some tactical ideas. And the problem is that the investment thesis is muddled by all of these issues that don't seem to go away but don't get resolved. So the tariff issues, we have no deals yet. Everyone's waiting for the deals. There are no deals to speak of, and it doesn't appear like there's any on the horizon. And then you have the threat to the independence of the central bank, which is existential, that is fundamental. And that's why you're seeing bonds underperform, do poorly, why you're seeing the dollar plunge. And this is a problem because it isn't a fixable, easy crisis to walk in and say, okay, you know, this hedge fund blew up, they need liquidity, or the banking system needs money or needs shoring up here or there. This is more at the heart of governance and the independence of the central bank, and that's not easily fixable.
Well, Kathy, in your view, what would it take for bonds to start doing what bonds are supposed to do in a stock market that's declining? What has to change, or what has to be known?
Well, I think what needs to be known is that we're going to leave the central bank to be independent, first and foremost, to do what it sees as the right thing to do. So get off Powell's case. And, whether you like Powell or not, it doesn't matter. Just hands off the central bank. That's important. And the second thing is to have an economic policy, frankly, that ties together, right? So we have tariffs that raise inflation and push down growth. We have now a fiscal policy that looks like it's going to be expansive. And all of these competing factors don't add up to something that you can look to and say, okay, this makes sense. So we need to get all these things to tie together and have a path forward. If we tip into recession, we need to know that the Fed can ease and that rates will actually go down rather than go up, because there are worries about fueling inflation by losing independence of the central bank. So got a lot of stitching back together to be done.
Eric Weiner here. We're hearing that there may be some kind of a lift-off if and when there are some tariff deals. Is that because there's suddenly some certainty in where we're going? Is that something that you guys are hearing, looking at, or anything along those lines?
Well, we've heard the same stuff. We've heard the same comments that, well, all we need to do is get some deals, and then we'll say this was all negotiating tactics, and we can move forward from there, because we'd have at least a map, right? We'd have a roadmap to say, okay, it's 10% across the board, and we can calculate what that means for the economy and maybe for inflation and Fed policy. So I think it would be helpful if we got some deals, but one of my colleagues was pointing out today that traditionally, trade deals take anywhere from 18 months to 3 years to finish up. So this is not usually something that's done in, a snap of fingers. There's a lot of things to work out with our trading partners. So the idea that we're just suddenly going to get a deal, I mean, maybe it will happen, but traditionally that's not how trade negotiations progress.